This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, onwards to a final and hopefully short session here to finish off the work that we're dealing with share disposal so far as companies and corporate tax is concerned. And if you've done as I asked you to do between last time and this, gone back and again looked at what we did when dealing with individuals in CGT, when they owned shares and there was a takeover involved, then you're basically not going to go too far wrong. It is all the same basic principles. There's just one new added ingredient when we come to dealing with corporate tax, and that, of course, is the availability of indexation allowance. How we accommodate that, actually, we'll see very soon, treated very friendly indeed by the ACCA examining team, where they allow us to take a little shortcut that, although not absolutely quite right from a technical perspective, does make life a whole lot easier for us. So we won't blame them for doing that now, will we? Okay, so what have we got here in terms of takeovers? Now, there's two different types of takeover for tax purposes that we need to look at. There is, to begin with, the pure share for share, paper for paper deal. So where a takeover is a share for share deal, otherwise known as paper for paper, you swap one category of shares in one company for shares in another company there. Because you've received no cash, no gain has actually crystallized. You've just swapped one bit of paper for another bit of paper. I own shares in A Limited, I now own shares in B Limited, or V Limited as the case may be there. So in which case, no immediate gain arises. The point, of course, at which a gain will arise is in the future, where your new shares are disposed of. And then what's the problem? You know what you sell them for, but what's the cost? Because you never went out and bought those shares in that new company, that B or V Limited there. You originally bought shares in A Limited. So what do we do? And it's a very, very simple calculation, whereby shareholders of the company taken over acquire shares in the acquiring company. Normally does not constitute a chargeable disposal. It's paper for paper. There is no cash. And here's the bit. The new shares are deemed to have been acquired for the same cost as the original shares. Again, an expression we may have used back when dealing with this in CGT for individuals is that the new shares step into the shoes of the old shares. They take on the cost of the old shares. Now, if I literally swapped one shareholding for another, ordinary shares in A for ordinary shares in B, then all of the original cost of my A shares would now be deemed to be the original cost of the B shares there. To make life, therefore, a little bit more interesting, as you'll see, as we reprise indeed in examples 4 and 5, what we did for individuals in terms of CGT, it only makes life a little bit more interesting if we get two forms of that consideration. So rather than just taking ordinary shares for the ordinary shares that you have in your original shareholding company, you take two different types of shares. You take some ordinaries and you take some preference shares. What does that mean? It means that instead of all of the original cost of your original shareholding belonging to the new shares, that is their cost, you've got to divide it. You've got to divide it between how much of that original share cost belongs to the new ordinary shares or belongs to the new preference shares. And that's what we see here. A takeover may involve attributing the cost of the original holding to the different component parts of the new holding, if a mixer consideration is received. And if you see this in the exam, this is always going to happen. Again, I can't see that you merely swap shares in A Limited for shares in B Limited and the B Limited shares take on all of the cost of the A Limited shares. You are going to have to split that A Limited share cost between two or more things, probably no more than two, and probably, as we've just said and is written here, a combination of both ordinary and preference shares in the new company. How do we do that? Very simple apportionment. It's done by allocating the cost of the original holding to the new shares according to the market value of what is received at the time of the takeover. So we will be given the information about not just how many shares in the takeover company we are receiving, but of course what is their respective share prices, their market values. So we will use now, in answer to example 4, to see how this technique is applied. Now, if you recall from what we did in CGT, then this is going to be exactly the same. There's just going to be one new component. How do we deal with indexation allowance? And as I've suggested to you, thankfully, the ACCA examining team have been user-friendly here and allow us to take a little shortcut, such as we will see. That makes life, well, a whole lot easier. Makes it quicker and easier to deal with the problem. We'll then see what would happen if you receive some cash, at least as part of the consideration where there is a takeover. Well, of course, if you receive cash, then immediate gain will arise. But that's an example 5. Let's have a little look at example 4. Right. Our client company, Z Limited. What had they originally done? Acquired 10,000 A Limited shares in August 89, and there's our cost, £10,000. In July 17, B plc takes over A Limited. And for each share in A Limited, Z Limited receives, right, what do we now receive? Now remember, we owned 10,000 A Limited shares. And for each such share, we get, for each share in A Limited, Z receives 2 B plc ordinary shares, valued at £1.50 each, and 1 B plc preference share, valued at £1. So all we've got to do is a nice, simple little working. You will need 2 columns, as we did before. We will list out the open market values of what you now receive on this takeover from B plc. What do we therefore receive? We receive B plc ordinary shares. What are the terms? 2 for each of the 10,000. So we own 10,000 shares in A Limited. We will receive 2 B plc ordinary shares for each such A Limited share held. And what are they worth? £1.50 each. So the market value of what we have received, 10,000 times 2, 20,000 times £1.50 is £30,000. And on to the B plc preference shares. What do we get there? For each of our 10,000 A Limited shares, 1 preference share in B, and that is worth £1 each. Not therefore too tricky a calculation. That is £10,000 worth of market value received. So we have received in total £40,000 worth of consideration from here, the company doing the taking over, B plc, and in the form of a combination of ordinary shares in B and preference shares in B. Total value 40,000. Now, because this is entirely share for share, it is all paper for paper, no gain will actually crystallise at this point. But at some point in the future, what's going to happen? One or other of either the ordinaries or the preference shares may be sold. And at that point, we will obviously know how much we sell them for. The problem is, how much will the cost be? So what do? The new shares take on the cost of the old shares. The old shares, the A Limited shares, cost £10,000. And hopefully, having revised this recently, you recall this well from the work that you did back at when looking at CGT for individuals. We now pick up that cost and use these market values as a basis for apportioning that cost. So we can see that to the ordinary shares, we'll take 30/40ths of that cost. 3/4, 7,500. To the preference shares, 10/40ths, i.e. 2,500. So what does that mean? It now means that that cost in August 89 of £10,000 that we'd actually incurred in buying the 10,000 A limited shares is now deemed to be a £7,500 cost on the ordinary shares and a £2,500 cost on the preference shares. So should either the ordinaries, or as we'll see in a moment's time in this question, the preference shares, should they be sold in the future, you will now know what cost figure they have. And last line of the question, the preference shares are sold in March 2018 for £15,000. And we're told here to assume that the indexed rise from, note, August 89, that was when we originally acquired our A limited shares, that the index rise through to March 18, when we now dispose of the BPLC preference shares, that indexation factor is 1.357. Now again, technically what we're about to do in terms of computing the gain on the preference share disposal isn't quite right. But let's go through that process and see how quick and easy it is to deal with. So we know that our sales proceeds for these shares, £15,000. Sales proceeds, £15,000. We know that the cost figure established from here, do check out, of course, that all of the shares are being sold. Here it is the preference shares. If you've been told that half the preference shares were sold, then you allocate half of that £2,500 cost now to this disposal. Here it's all of the £2,500 because we sold all of those shares. So we come down to an unindexed gain there of £12,500. Away from which we deduct indexation allowance. Now this is the shortcut. I'll explain to you in a moment's time what we ought to do it properly, but the shortcut exercise here makes life so much easier. They've given us an indexation factor that runs from August 89, when we first acquired the A limited shares, all the way through to March 18, when now we dispose of the BPLC preference shares. All we've got to do, therefore, for indexation, pick up the indexation factor, 1.357, and multiply by our allowable cost, that being £2,500. Get your indexation allowance, and that's going to be something less than 12.5, so it will still result in a chargeable gain arising. Let's just have a little look at the answer page for that, so save doing all of that over again. Where are we? Here we go. There's your proceeds, £15,000. There's your cost, £2,500. Here's our indexation allowance calculation, doing the shortcut method. That gives you 3393, all being well. Check the number out again as usual there, which hopefully brings it down to a chargeable gain of £9,107. What we also know for future reference is that should any of the ordinary shares in BPLC be sold, that the cost of those ordinary shares when sold will be £7,500. Now, to do the job properly here, we shouldn't have been making this shortcut of simply looking at the cost and not dealing at the time of takeover with index cost. So what we should have been doing is, when you did the takeover, you can see here everything that we wrote down before, market values, splitting out the cost of the A limited shares. We should also have picked up whatever at the date, I think it was July 17 when the takeover took place, what was the then index cost figure in relation to that. Now again, the index cost figure, I'll make a number up, I don't know what it is, but might have been something like 23, let's make it 24,000. That's going to be easy on the calculations. If it was £24,000. Now what would we have done? We would have split out that 24 in the same way as we split out that 10,000 according to those market values. So 3/4 of the 24, 40ths would have gone to the ordinary shares. That would be 18,000. And then to these preference shares, 10 40ths. That would be £6,000. And what you'd have done, you'd have created for your BPLC preference shares, you'd have created a new share pool in which you'd have recorded number, cost, and index cost, which at, I think it was July 17, just check back, but I think the date of the takeover was July 17, we would have had, how many shares did we have? 10,000 shares with a cost of £2,500 and an index cost of £6,000. So that then when we came through to our disposal date in March 18, what you'd have done is your normal re-indexation, looking at the RPI in March 18 compared to July 17 when those figures were established, and apply that to your index cost figure. That would give you a revised index cost of these shares. Now, it's not difficult to do that. All you're doing is to include one more column on your working up here, index cost, but establishing that index cost by taking what was the cost of your original shareholding. It was originally £10,000, and indexing from the time when you bought your A Limited shares all the way up to the date of the takeover by B Limited, which I think was August 89 through to, I think it was July 17, as we keep saying there. Do your re-indexation, split that 24,000 according to those market values. Those then would give you the starting point for establishing a new share pool on your preference shares. You'd equally have had a new share pool in relation to your ordinary shares. You'd have had 20,000 shares with a cost of 7.5 and an index cost of 18. And from that point onwards, it's business as usual. Wherever there is an operative event, a further acquisition, probably for us just a disposal, you would re-index, establish what your revised index cost is, and then calculate the gain on disposal. It ain't rocket science. Okay, now again, that information about what we should be doing in real life is given there, but what we have had to do here, and hopefully should be, we'd expect to see what we'd have to do again in a real exam question, is just don't even worry about that index cost column at the time of the takeover here. That is not going to be required, because all they do in the question, as we gave to you in this particular question, they give you, here's the information, the index rise from when you first bought your A Limited shares to when eventually you sell the shares you acquired on the takeover, or here some of those shares, this being the preference shares. Right. Look back through that exercise, make sure you're happy with what's being done. At the time of takeover, remember, it's share for share, no gain crystallizes. The new shares take on the cost of the old shares. Where there's a mix of shares, mix of consideration received, we split that cost according to the market values of what we have received. That forms the base cost of your new shareholding. So when sold, what do we sell for? What was the cost? That's where it came from. And we're giving it an indexation factor. Again, on shares with share pools, we shouldn't be using indexation factors, should we? We should be looking at the RPI now, less what it was, over what it was, leave it in the calculator, multiply by index cost. All the examiner is doing is to make life easier for us. And as I say, we won't criticise them for that now, will we? Work out your indexation, you get your chargeable gain. Back in terms of this example, that number, as we saw, should be a gain of £9,107. Right, check that through, pause this if you need to at this point in time, but there's only one simple little exercise still to do, and that is example 5, where one changeover will occur and we're actually going to get cash. But if you need to pause to go back and reconsider again what we've just done, please do so. Otherwise, stick with it and we'll complete this exercise, this particular chapter. Okay. As per example 4, but what difference would it make if Z Limited receives at the time of takeover, again, exactly the same ordinary shares, 2 BPLC ordinary shares valued at £1.50, and instead of £1 worth effectively of preference shares, we get £1 cash for each share in A Limited. And again, they give us an index rise from August 89, this time correctly through to July 17, because what we now need to do is to establish at the point of takeover, you've received cash. If you've received cash, there is a gain to be computed. The cash receipt being your sales proceeds, you need a figure of cost, obviously, to put against that, and with it, a figure of indexation. So that indexation factor now, 1.275, we're just saying to use here. Right, what would we have? Remember the technique. List out the market value of the goodies received, the consideration received, ordinaries and cash. Ordinaries, 10,000 times 2 shares, 2 BPLC ordinary shares, valued at £1.50. Exactly as we had before, 30,000. Cash, for each A Limited share, £1 in cash. There we go, that was that. So 10,000. So exactly the same numbers, except that that 10,000, instead of being another shareholding, another bit of paper, preference shares, what it is now is cash. Total value, 40,000. We use that to split out your original A Limited share cost, which was 10,000. How do we do it? 30 40ths, 10 40ths, allocated to ordinaries and cash. 7,500 as we had before, 2,500. And as soon as you've got that, you have the basis here for establishing your chargeable gain. You now know that you've received cash of £10,000. So you'd have a calculation of the gain. Pardon me if I just squeeze it in here. Sales proceeds, the cash received, 10,000. Cost, 2,500. Down to 7.5. Indexation allowance, your 2,500 times. There's the indexation factor, 1.275. Multiply it through, get your indexation allowance, and the job is done. You have your chargeable gain. Now again, hopefully we've seen what we've done there. List out the market values of what we received. This time, because cash is one of them, that means that in relation to the cash received, there will be an immediate gain. If you've got cash, then there is an immediate gain. We need to know how much of our original A Limited share cost belongs to the cash received. Answer, 2,500. There you go. Your sales proceeds, £10,000, the cash received, that's that figure, and your 2,500 is your cost. They give you the indexation factor from when you bought the A Limited shares to the time now of takeover when you receive the cash. At this point, the gain crystallises. Therefore, multiply it through and you've got your gain. If we look at that in our answers now, here we go. Immediate gain arises. How do we compute it? Use the same basis of using market values to split out the same original A Limited share cost. Same outcomes, there's the split. We want that cost to go against your cash received, there's your sale proceeds. Indexation, there's your cost figure, times this given indexation factor, take out your indexation allowance. You've got your chargeable gain. Thank you very much, job done. The difficult thing about dealing with takeovers is making sense of the order of events. Always follow it through chronologically. What makes a question difficult in terms of takeovers is that they tell you that, for example, on the first exercise that we did, where it was ordinary shares and preference shares received, that rather than telling you we bought our A Limited shares, then there was a takeover, and then one of the shareholdings acquired on that takeover we sold, giving it to you in a logical sequence of events, chronologically based. What they do in the question is to say that back in this particular question, in March 2018, the company disposed of its entire shareholding of preference shares in BPLC. But as you then read through the question, you discover, we didn't actually go out and originally buy preference shares in BPLC. We acquired them as a result of a takeover when BPLC took over the shares in A Limited there. So you've got to backtrack and actually find at the start, what did you originally buy? 10,000 shares in A Limited costing £10,000. Then move forward to the time of the takeover and do the exercise that we see there. List out the market values of what you received and split your original cost between those shareholdings, or as in example 5, shareholding and cash, split according to the then market values. If, as here, of course, it was then just share for share, there was no immediate gain that arose, and therefore, what do? We're calculating original cost figures. Once you have them, then you move forward to the disposal. All right, so we sold these preference shares for, what was it, £15,000. What now is the cost? Go to your working, the cost was £2,500, do your indexation. The difficult thing is sequencing the events in a chronological order. The question looks more difficult than it is, because what they tell you first is, this is what we sold. When you see that we sold preference shares, you expect to be told when you bought and how much you paid for those preference shares. But it doesn't work that way, because how you acquired them was via the takeover. So always, in planning your answer, what was the original acquisition? What then were the terms of the takeover? Split the original cost between the things received at the time of takeover according to their then market values. Once done, you now have your base costs to deal with any subsequent disposal, whether it had been in this particular question of the preference shares as it was here, or whether it had been those ordinary shares. We would still have known a cost figure in relation to the ordinaries. Then move on to that eventual disposal. Okay, go back through, make sure you've understood all that is there. That brings this particular chapter to an end. Again, we move on then, when next I see you, to another chapter exploring other issues pertaining to our chargeable gains and corporate tax, some of which will be a revisit back to things that we did back when we dealt with personal tax and CGT for individuals, and other bits that will be new. All that awaits us next time.